Gold should be rising right now. That's the starting point. We have geopolitical tension, conflict involving Iran, and growing concern around the Strait of Hormuz, a narrow stretch of water that carries roughly 20% of the world's oil supply. In almost every previous market cycle, that kind of risk pushes gold higher. It's one of the most consistent patterns in financial markets. And yet, this time, it didn't work the same way. Gold pushed higher, briefly. It moved toward the $2,300 level, reacting exactly how you would expect in the early stages of uncertainty. But then something changed. The move slowed. Momentum faded. Buyers stepped back. And in several sessions, gold actually pulled lower, even though the headlines had not changed. That's not normal. And when something stops behaving the way it usually does, the market is telling you something important. Because gold is not just another asset. It has a long history, and that history matters if you want to understand what's happening now. Long before modern financial markets existed, gold was not traded on screens. It was stored, hidden, protected, used as a form of real wealth. Empires built reserves of gold not because it moved quickly, but because it held value when everything else failed. Even during periods of war and instability, gold was something people physically held. That behavior didn't come from theory. It came from experience. Over time, gold became the foundation of monetary systems. The gold standard tied currencies directly to gold, limiting how much money governments could create. In the United States, that system lasted until 1971, when President Nixon ended the convertibility of the dollar into gold. That moment changed everything. Gold was no longer directly tied to currency. It became a freely traded asset. But the psychology didn't change. People still saw gold as protection. And that belief carried forward into modern markets. Even today, central banks still accumulate gold. According to the World Gold Council, central banks purchased over 1,000 tons of gold in 2022, one of the largest annual increases on record. Countries continue to hold gold because it represents something stable in a system that is constantly changing. So when gold moves differently, it matters. Because it reflects more than just price. It reflects how the entire financial system is responding to pressure. Now, if you look back at previous crises, the behavior of gold was much more straightforward. During the 2008 financial crisis, gold rose from around $700 to over $1,000 as confidence in banks and financial institutions collapsed. That move wasn't random. It was driven by fear, falling interest rates, and a shift away from risk assets. Then in 2020, during the early stages of the pandemic, gold surged again. It moved from roughly $1,500 to over $2,000 in a matter of months. Why? Because central banks injected massive amounts of liquidity into the system. Interest rates dropped to near zero. And the opportunity cost of holding gold disappeared. Those were clean environments. Everything pointed in one direction. Fear was rising. Liquidity was increasing. Rates were falling. Gold had no resistance. But today, that alignment doesn't exist. And that's where most investors make a mistake. They assume the same rules still apply. They expect gold to behave the same way. But the environment has changed. And this is where the current move starts to make sense. Because right now, gold is not just reacting to geopolitical risk. It's reacting to interest rates. It's reacting to the strength of the US dollar. And it's reacting to positioning in the market. And those forces are not aligned. Start with interest rates. Gold does not produce income. It doesn't pay dividends. It doesn't generate yield. So when interest rates rise, or even remain elevated, holding gold becomes less attractive compared to assets that provide income. This is one of the most important drivers of gold, and it's often overlooked. Right now, US real yields, which adjust interest rates for inflation, have been sitting roughly between 1.5 and 2%. That might not seem extreme, but compared to the last decade, it is. For years, real yields were close to zero or even negative. That environment supported gold prices. This one does not. And that creates a structural headwind. Then there's the US dollar. The dollar index has been trading near multi-month highs, supported by higher interest rates and continued demand for US assets. And because gold is priced globally in dollars, a stronger dollar makes gold more expensive for buyers using other currencies. That reduces demand. So now you have two major forces working against gold at the same time. Higher real yields and a stronger dollar, both pushing in the opposite direction of what geopolitical risk is trying to do. And this is where the market becomes more complex. Because gold is no longer reacting to a single narrative. It's reacting to multiple forces at once. And when those forces don't align, you don't get a clean move. You get hesitation. You get volatility. You get moves that start strong, then fade. And that's exactly what we're seeing. But there's another layer here that matters just as much. Positioning. Markets don't just move based on events. They move based on what investors have already done. If a large number of investors expect gold to rise during geopolitical tension, many of them will already be positioned for that move. Which means the move is already priced in. And when that happens, there's no one left to push the price higher. So instead of a sustained rally, you get a spike, then a stall. And sometimes, a reversal. Not because the story is wrong, but because everyone already acted on it. This is something professional traders focus on constantly. Because often, the most important signal is not the initial reaction. It's what happens after. Does the market continue? Or does it fail to follow through? In this case, gold failed to follow through. And that tells you something important. According to Bloomberg, recent gold price action has been more closely tied to real yields and the strength of the US dollar than to geopolitical headlines alone. That's the shift. And it changes how you should think about this market. Because this isn't just about gold. It connects to a broader system. Look at oil. When tension rises around the Strait of Hormuz, oil prices tend to react immediately. Because that region handles roughly a fifth of global oil supply. Even small disruptions can move prices several percent in a very short period of time. We've seen oil move 5 to 10% during periods of supply shock or heightened geopolitical risk. Those moves have real consequences. They impact inflation. They increase transportation costs. They affect manufacturing and consumer prices globally. Countries that rely heavily on energy imports feel that pressure immediately. At the same time, energy exporting countries benefit. So oil reacts directly to physical supply risk. But gold is different. Gold reacts to financial conditions. And right now, financial conditions are dominating. That's why the move looks different. Because the market is prioritizing interest rates, currency strength, and liquidity over simple geopolitical narratives. And this is where investors make their biggest mistake. They rely on simple rules. War equals gold up. Inflation equals gold up. Uncertainty equals gold up. But markets don't operate on simple rules. They operate on expectations. And expectations change constantly. So if you only follow headlines, the market will feel unpredictable. But if you watch how price reacts, especially when it doesn't behave the way you expect, you start to see what is actually changing. And that's where the real insight is. Because the most important signal is not what moves. It's what doesn't move when it should. And right now, gold is telling you something very clearly. The environment has changed. And if you understand that, you stop reacting to headlines. And you start reading the market properly. This is not financial advice. Always do your own research before making investment decisions.